I'm here to tell you that you're using dollar cost averaging all wrong. And once I figured out how to properly dollar cost average into stocks, I was able to find 636% returns in one single year in 2025 on my investing account. So hang out with me for a few minutes and I'm going to explain how I properly use this strategy to increase my returns, reduce my risk, and properly apply the system that I've built to get me those returns that I mentioned earlier. So let's hop into dollar cost averaging. First, let's talk about dollar cost averaging and what the old definition of dollar cost averaging is. So DCAing is an investment strategy involving investing a fixed dollar amount at regular intervals, such as $100 a month, regardless of the share price, to reduce market timing risk. It lowers the average cost per share over time by purchasing more when share prices are low and fewer when high, fostering disciplined long-term investing. Now, this definition is a little bit contradictory because it talks about investing regardless of share price. And then the second half of the definition, it talks about going in more when the price is lower. So if you're using an indiscriminate DCA strategy, such as a time-based DCA strategy, that is going to light your account on fire and you're going to put yourself at significant risk. So when you're DCAing into things, I know that there's some technologies like Coinbase that have this, where you can buy $1,000 of Bitcoin every week or every month, regardless of price. So those people that were DCAing into Bitcoin at 125,000 are definitely regretting that decision. In order to supercharge your investing results, you need to learn how to DCA first based on price and second only in a specified buy zone, and to not keep chasing price higher and higher. That doesn't do you any good. So let's talk about the drawbacks of this lazy, easy DCA strategy, time-based DCA strategy. So first of all, it's lazy. It can raise your overall price. And then this leads to lower profits on what you're investing in. It doesn't factor in technical analysis. And eventually you're going to lose money when the stock enters into a stage 4 drawdown. So let's go to the charts and take a look at the Apple chart, and I'll tell you why this strategy doesn't work. So if you've been DCAing into Apple for the last 15 years, you've been buying, I guess 10 years here, you've been buying at prices like 20, 38, 50, 81. And so these buys here are looking pretty good now. You've done pretty well for yourself. But imagine back in 2018, you're buying a bunch of stock at $55 only for the stock to crater to 36. Now, maybe at the time you feel like you don't want to invest anymore, that there's a huge risk. So you take some time off here and then you resume your DCAing as price goes up. But as you're DCAing in, so does your average cost is going up. And so your returns as price continues to grow are going down. Why not find stocks that you can DCA into at the bottom and watch those returns grow over time versus DCAing in here at the top? So if you DCA'd in at $260 on the in December of 24, you suffered almost a 50%, about a 40% drawdown here, and you were probably not feeling too good about yourself. Again, if you're DCAing in here up at $285, you're not doing yourself any favors for when this enters into its stage 4 drawdown. Now, you might think a company like Apple is exempt from that, but no company is exempt from market cycles. It will eventually happen. So let's talk about how you can properly DCA, and we'll start by redefining it. First of all, we're going to use a price-based dollar cost average, and we're going to pair that with technical analysis. So we're going to set specific buy zones on charts where we're going to buy stocks. And these are going to be, like I said, zones. So for example, it might be from $1 to $5, $10 to $20, $10 to $30. It's going to look something like that. And so when you pre-plot out these zones, when you know about support and resistance levels and how they work, you're going to use those support levels, those support zones to create those buy zones. And then you're going to only enter when price is in that buy zone as you get more and more attractive prices. So for example, if the buy zone goes from $5 to $20, you're going to take a nibble at $20. When price gets to $10, you're going to add more. And when price gets to $5, you're going to add a significant amount that's going to bring your average down. And an important part about that is to predetermine these lot sizes. So for example, you might buy $1,000 at $20. You might add $1,000 at 10, and then you might add $2,000 to $3,000 when it gets to $5. And that really helps rewire your brain to want these price fluctuations and being able to act aggressively when you get the right price. It's hard to do when you don't understand technical analysis, but with this system, we can do this with confidence. So let's talk about the benefits, and then I'll show you what this looks like on a chart. So make sure you stay tuned for that. So the benefits, like I mentioned, it helps rewire your brain for short-term price fluctuations. You actually want the price to drop and come into your buy zone. It also increases profits by helping you average down into the stock. So if the stock is eventually going to get to $20, if you buy it at $1, you had a 20x. If you bought it at $5, you only had a 4x. So you're obviously going to want 20x returns when you can get them. It also reduces risk by buying when you're butted up to that support level. Support levels do break, but it's when you use the 80-20 rule, 80% of the time when you have a significant support level, price is going to bounce. So when you're entering at that low price, when you're entering at $5 instead of 20, you have a lot less to lose when price breaks below and goes to $3. Percentage wise, you're going to do much better. And then just a little tip, when you do this and you do want to use a stop loss, set your stop loss below the very bottom of the buy zone. Don't make it like a penny, make it 10, 15% below. Because if you're familiar with the WHOP theory, the Wall Street likes to go and stop hunt and stop you out at the very bottom, only for price to continue right up. So don't put it right there at the very bottom of support. So if you're buying at $5, maybe you put it at $4, $4.50, something like that. You don't want to set it at $4.99. That makes no sense. Or if you're even an aggressive trader and you love the stock long term, a lot of times there's stocks that I continue to buy DCA into after they've broken support. And again, that's an advanced concept that has to do with the WHOP accumulation pattern that Wall Street uses, like we mentioned. So let's jump into what this looks like on a chart here for Lithium Americas Corp. And this is actually a stock that I have alerted for our group members. And this is a stock that I'm continuing to purchase as price comes my way in my longer term portfolio. So let's take a look here at the chart. For those of you that haven't used technical analysis, you need to start. So here we have a support zone that I've marked at $3 to $5. Now, why did I use those numbers when price has been as low as 30 cents up to $3 here? Well, we have a bullish trend line here that is supporting price. So once you have these 2 points, you can connect the dots and extend it right. And you can see that price is continuing to respect this trend line. You also have a bearish trend line that's broken. So that's a good confirmation here. But we've had an explosive move here from $2.70 to $10. And now you're getting a retest of this buy zone. So we set our buy zone above this bullish support line because it's not likely that price is going to get down into the $1 range anymore. And if it does, the stock may be in trouble. But given what's going on politically with mining, critical minerals, and the government, and all that kind of stuff, we feel really good about this name here. So what does proper DCAing look like in practice for a name like this? Well, about a week ago, we alerted this name and alerted the buy zone of $3 to $5. As prices come back into this zone, it's hit that $5 level, at which time I started to build a position. So if you've heard the term build a position, that's just not like a made up term. That means you're using DCA to start building the right size position for the price that you're getting. So what I might do at this $5 level, like I mentioned, is enter in with $1,000 buy. As price continues to work against me at $4, I might be interested in adding another $1,000. And then in my system, when price gets down to $3, which is really the very valley of support, starting to touch on this trend line, at $3, I'm going to make my most significant buy. Typically twice or three times as big as my total position so far, because that's where the risk reward is really in my favor. So let's do the math on this. If you bought at $5 and the price goes to $25, you made 500%. Still a super great trade. But if price comes down to $3 and you DCA'd in, let's say your overall cost is, we'll say $4 to make it easy. At $4, that same move up here is a little over 600%. So that extra 100% can really help compound your portfolio. So that's why things like this are so important to learn versus just randomly DCAing in. Again, if we had done this in the past and you're DCAing in here at 17 bucks, 25 bucks, 25 bucks, and then it enters back into a stage 4, you're not going to be too happy about that. So we need to learn these market cycles. We need to learn technical analysis. And now we're learning how to properly DCA in. So if you've been using traditional time-based DCA, you've been doing it completely wrong. So I hope that this was helpful, a helpful explanation for you. And again, if you want to learn exactly how I'm applying strategies like this to the Bison Blueprint and how I'm able to achieve those 600% results in a year, check the information below. There will be a link to sign up for our free Discord. There's a link to a 7-day free trial. And then there's a link if you want to get involved and finally start making the money that you're hoping to make in the stock market. You can join our community on Discord and both start getting these alerts, education like this, and participating in our chat room where we're talking about stocks, we're sharing ideas, I'm giving you feedback on charts, and you're able to finally get those results that you're looking for.